Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And tonight we're going to go over all of the trades that we made on Tuesday, December 9th. So we didn't have any trades yesterday, so no video yesterday, just didn't get anything filled. And again, just as a heads up, we try to stay a little bit more passive and patient when it comes to making trades when implied volatility is actually really low. So we generally don't have as many trades when IV is low and the markets are high, and we really ratchet it up when implied volatility is high. As probably some of the videos that you can go back through the archives and see, we've done anywhere between 15 and 20 trades on days where the VIX is over 20 or 30 or whatever the case is. So just as a general rule. One quick announcement. Again, if you haven't signed up for the webinar, there's a couple spots left. I haven't updated the webpage. I think there's maybe 4 or 5 seats left for the trade adjustments webinar, but we're going to go through kind of one trade adjustment tonight in GLD, and that's going to give you a little bit of a taste of what we're going to do on that trade adjustments webinar. So you can either sign up for a premium membership and save a little bit of money, because we're going to be doing another webinar, not this Thursday, but the next Thursday in December, kind of trying to fit 2 webinars in before the end of the month, talking all about directional debit spreads. So making directional trades, how we place them, what time frames we use, what strikes we use, what type of credit that you want to receive, or what type of debit you want to pay. So all of that we'll be going over in the next webinar. Again, not this Thursday, but the next Thursday. But again, if you haven't had a chance to sign up for the trade adjustments webinar, I suggest you do. Like I said, I think there's only 4 spots left. I haven't updated the webpage to reflect that. So in tonight's video, I want to go over the adjustment trades that we had today. We only had 3 adjustments that we had sent out, and the first one was a combo order kind of in XOP. So we had an inverted strangle in XOP, the 49 calls and the 67 puts. And when XOP and oil opened up this morning, actually a lot of those opened up lower. So oil opened up dramatically lower and completely reversed throughout the day. And as a result, things like XOP and RIG and USO all opened up much lower and then reversed higher. This actually ended up being pretty lucky on our end. And again, it's nothing more than just luck, being in the right place at the right time. But we were able to roll our entire strangle out to January from December earlier in the morning. And we took in a massive credit to be able to do that. And a pretty good credit considering that it's only, the 67 puts were deep in the money. So to be able to roll those out for no credit or no debit was actually pretty good. And that's why I like the trade. So again, logistically, the way that we did this is we used the sell order of a calendar. So we used a calendar to facilitate the roll of our short options. So remember, when you're selling a calendar, you are selling the back month, which is the January, and you're buying the December, which is that front month. Now in this case, we were already short the December 49 calls. So when we bought the December 49 calls, we closed out of that position, and then we resold that same strike for January. So again, you can see how this calendar facilitates that roll from December to January. Now, when it came to the call side, we were able to take a very nice credit of 92 cents for each of those calendars that we rolled. So that 92 cents helps expand the break-even points on this strangle, helps move it out even more than it is right now. Same thing on the put side. What was really great about this deep in the money put, because remember, XOP is trading in the mid 40s. And our put is actually at 67, so it's very, very deep in the money. Our put option that we're short, but we were able to roll this out to next month for no credit, no debit, for basically 0 price. So the same price that we have it now, we rolled it out to January. And why this is important is because it's showing you that actually front month implied volatility is much, much higher on XOP than back month for the put option. So in this case, that front month implied volatility is about the same as back month. There's no advantage right now for anybody who's buying put options to go January versus December, right? So there's no price difference, no time or volatility difference. It's about the same price. So that was really good that we were able to do that and get filled pretty quickly. And I know everyone else got filled pretty quickly on that as well. And again, going to the chart here, and we'll get back to GLD, which is on the screen. But going to XOP, you can see here I've got implied volatility down in the bottom screen here, and you can see implied volatility is up in the 93rd percentile right now. It's extremely high, and we had a very nice rally off of the bottom And so we definitely want to see, as we start to get towards January, which is all the way out here now, so we've given ourselves a lot more time to be right. We definitely want to see oil start to trend higher than it's going right now. And it's got a pretty big window that it can kind of land in. We don't really need it to go necessarily to 86 or I'm sorry, 67, whatever the case is. But this is our new window here with oil. We basically like oil to trade anywhere between about 43 and about 73 or so. So that's the ideal range. Adding up kind of all the credits that we've received on this position, we'd ideally like to see oil trade anywhere between that range. So it's quite a big range. The best range that it can trade in to kind of maximize what's left in this position is somewhere between 49 and 67. So that's ideally where we want to go, and you can see we've definitely got a little bit of upward movement to get to that point till we kind of maximize the potential of this position. But that gives us a good opportunity to extend the trade that we have and move it out to January, buy ourselves a little bit more time. When we look at the other trade that we adjusted today in GLD, I really like this adjustment in GLD for two reasons. One, it's the second adjustment that we've made to GLD, and all of them have been pretty good as far as taking in a pretty decent credit for the options. The second reason I like this adjustment is because it reduces our max loss that we could possibly have at this point, and it gives us some extra money in case we are right and GLD kind of falls in the last 8 to 9 days here before expiration. It gives us some more credit to kind of beef up the position that we had, and we've done a really good job this month trading GLD. We had that nice straddle that we made some money on, so hopefully this position in GLD will work out as well. I wanted to actually kind of go through the position before the adjustment, which is what you guys see on your screen right now. This is the position that we had in gold before we made that adjustment. And then what I want to do is kind of add the other adjustment that we made today. And again, this kind of goes along with what we're going to do, just much more in depth with a bunch of different strategies in the trade adjustments webinar coming up on Thursday. But this is the position that we had in GLD, and you can see it's kind of an unbalanced condor. So we originally added this extra leg over here to the position. So we had, kind of a little stair step iron condor going from our original position. But now gold is all the way up over here. So you can see that on the top side of our trade, we're getting tested to this side. So gold is continuing to move much higher, and today was up, almost $1.50, I believe GLD was. So none of our risk is really to this side, right? We could have gold fall from 118 down to 111. It could fall almost $7 and we still be okay, right? We'd be, kind of testing this side, but we've got a much bigger range, and that's really not where the risk in this trade is. Now, the risk in this trade is obviously if gold continues higher. So if gold continues higher and expires above 120, we stand to lose at this point about $318. So that's the real risk that we would lose if we kept this position as is before the adjustment. If gold kind of settled into a little bit lower of a range from here, we'd make about 282. Okay, so a little bit less than 50-50 bet, right? So we're making a little bit less than $1 for every dollar that we're putting up at risk. Now, with today's adjustment, what we decide to do is add another put spread to this side of the trade. So we add another put spread to this side where our risk is not, and that helps shift this entire profit loss diagram over to the right. That helps bring this break-even point from here a little bit further out. So it gives us a little bit more room based on the credit that we received. And it also moves up our max loss on both ends of this trade. So both ends of this trade, it moves up our max loss so that if, God forbid, GLD does move outside of this range right now and doesn't kind of settle into a little bit lower of a trend before expiration, at least we're going to lose money. And again, that's the whole key with trade adjustments is everyone wants to make money with adjustments, and you can make money with adjustments. But the key with trade adjustments is to reduce your risk. That's your number one goal, right? You got to play defense. And it's like being in a hospital, right? If somebody comes in, they're bleeding on the table, right? Which is your trade, is kind of bleeding, right? Losing money. The first thing you do is stop the bleeding, right? Then you can worry about, saving their life. But you can't even save their life unless you stop the bleeding. That's really what trade adjustments are about, is about stopping the bleeding, reducing the risk wherever possible. And that's hopefully what we, get across with these videos. So once I add the adjustment that we had, the 116, 114, now you can see how it creates kind of another layer to this iron condor. So now we've got, a couple little stair steps. But again, what we did is we added that side to the trade right here. And this gives us another credit that kind of, again, moves out our break-even point further. So now our break-even point's all the way out here, gives us about $1 of extra room in GLD. We did give up a little bit of downside possibility here, but again, our risk isn't, to the downside at this moment. And with so little time left to go till expiration, I feel comfortable making this trade a little bit closer because it kind of pins GLD into a tighter range, which it should trade in between now and expiration. Now, what's great about this is that now if GLD stays anywhere between 116 and 118, we could make $393. And if it, God forbid, goes all the way above 120, instead of losing about 318, now we lose about 207. Okay, so you can see that how much we've reduced our potential risk on this trade just by making this one adjustment. Really cool adjustment. It's a little bit more advanced. So if you're a beginner, just take your time, maybe watch this video 1 or 2 times. But again, you can see how we're just continuing to make adjustments and reducing our risk all along the way from our original position. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please add them right below this video. Make sure I get back to all of those tonight or tomorrow before the open. And if you're watching this video somewhere else out there online or on YouTube, you just have to understand that this video and these alerts are coming out publicly about 15 days after they're sent out to our members. So if you want to get real-time trading alerts in this video every night that goes through all of the trades that we make, open, close, adjustment, you've got to sign up for a membership at optionalpha.com. Until next time, happy trading.